and welcome to Bloomberg Quint. You're watching the fine print. The big story for today, massive pruning of items under 28% tax bracket, relief on return filing timelines, increase in the composition scheme threshold, and more time to avail of transition credits. The Goods and Services Tax Council's decision are a huge positive for taxpayers. To discuss the extent of impact, I have with me Mukesh Bhutani of BMR Legal, Anish Tripathi of Lakshmi Kumaran and Sridharan, and R. Muralidharan of Deloitte India. Gentlemen, thank you for joining me on the show today. Mr. Bhutani, I'd like to start with you. The massive pruning that we have seen today by the GST Council of the 28% tax bracket, almost 80% items have come from 28% to 18%. Is it fair to believe that the Fitment committee that set these rates to begin with was off mark, and so far this 28% tax bracket has worked as more of a revenue generation rather than a revenue neutral approach?
Well, I think, Payaswini, if you go back to the first credible document that was available with the government on the rate, this is Dr. Arvind Subramaniam committee, which had recommended a revenue neutral rate of between the range of 15.5 to 16.5%. Clearly, I won't say that the government did not adhere to the recommendations that were there, but it was more driven by two considerations: that if there is going to be a significant amount of revenue that will be foregone to provide for, in those days, what was the biggest concern for the government was the inflationary impact on GST law, and hence they wanted to keep the essential items that contribute to the inflation index low. And if I recall, in those days, for the Fitment committee, the driving force was roughly around 80% of the items that contribute to the inflation index should be kept lower than what the existing extent rates were at that point in time, which left no other option with the government but to come out with a long list of over 250 items falling in the 28% category, which originally was envisaged as the sin and the demerit rate, but it didn't turn out to be eventually. So I guess there is realization now. Part of the realization could be that the inflationary impact of introduction of GST has not been as the government had feared, and hence there is greater degree of confidence. In addition, most people always believe that the 28% fitment rate indeed encompassed a significant amount of products which fall also in the daily consumption. They may not be contributing to the inflation, but they certainly are falling in the day-to-day consumption. So there is realization on that aspect. I also feel that quite a few items that have been taken away from 28% are also contributing or could contribute to the inflationary impact as well, besides the pocket of the common man. So I guess this is something which in my view was anticipated. I think the positive way to look at it is to say that the government is not being rigid about the 28% rate and is willing to look at it. The fact that almost 75% of the items have been moved away from 28%, and I'm not able to make out exactly, because on one hand it's being said that this is transitional. Now, does it mean that some of the products will move back to 28%? I'm unable to make any assessment of that, but I hope that this is not transitional as I understand, but this is permanently moving away from 28 to 18%, and that there is no rethinking to bring some of these products back into the 28% category. So overall, it's a positive change. Yes, one way of looking at it is possibly that the Fitment committee was off the mark, but I think this is a positive, clearly outcome of the 23rd GST Council meeting.
Sure. Mr. Muralidharan, let me bring you in. And I take your point, Mr. Bhutani, that, that the government is listening and the GST Council is responding to the industry demands. Mr. Muralidharan, earlier in the evening, we spoke with Deputy CM of Delhi, Manish Sisodia, and he made a comment that, look, by putting these daily use items under 28% bracket, all you did was have the informal market flourish. Was that your understanding too? And now by making, reducing or pruning this 28% tax bracket, are we looking at probably more compliance?
No, actually, in terms of when the GST system got introduced, one of the main factors why it was widely welcomed was the fact that GST would have a moderate rate of tax and, of course, a wider tax base. So that was the premise under which GST got introduced. And as Mr. Bhutani rightly pointed out, the first official document, or rather like there was one more document before that, the 13th Finance Commission, in fact, Dr. Kelkar in fact suggested a 12% GST, so that he believed that a lower rate of tax would ensure better compliance and therefore the tax revenues also would not get affected. So then the Chief Economic Advisor pointed out that 28% rate should be limited to a handful of sin items. That was the word used. So therefore, when about 228 items were put in that bracket, the only premise or only surmise we could have is that that was more of a revenue raising measure, because there was a pressure and there was a 5% tax rate which was introduced to neutralize that. The government had to put equal number of items in the 28% category. So that seems to be the reason, and the other reason could be like we had an excise duty of 12.5% and a VAT of 14%. So all together about 25-26% was the tax incidence under the earlier regime. So they thought 28% may not mean much of a difference. So I think that the revenue consideration seems to be the main reason why it has been so many items have been put in the 28%, and now we are moving perhaps in the right direction, that drastically they have been reduced. Now only 4% of the total goods are in the 28% category, but I would believe that still the 50 items which are there cannot be categorized as sin item, and there is a scope for even bringing a lot more items back to the 18% category.
Yeah, we are never satisfied and content, right? Anish, help me weigh in here with your view on, do you see this as a marked change in the approach that the GST Council has towards looking at rates? Because initially maybe they thought that, oh, we don't want the revenue collections to fall short, so let's put as many items as we can justify 28%. But now maybe in the initial months, looking at, what the average, number of collections has been 90,000 crores, maybe they have got some relief on that front, so they thought that maybe a reduction in this category merits a relook.
So I would go back to what Mr. Bhutani said to start with. This is a paradigm shift in terms of the way the council is looking at rates. It is driven by two factors. A, inflation is under control, which is very good, which has never happened before. Any country which introduced GST, inflation went through the roof. And secondly, it seems that revenue flows are stable. At least that's what the government believes. The government would know better. While fixing rates, the overriding principle earlier was equivalence, and it was A plus B equal to C. So excise plus VAT should be equal to the approximate GST rate. And it actually was almost obsessive that if there was a minor difference also, which we saw in the auto sector, that no, you should actually increase it by a couple of, the cess was increased so that you could achieve equivalence.
That revenue neutrality.
I think this council meeting has moved away, and now they are going to look at the products. If a product is what you can call, let's say, a standard product, it should fit somewhere between 12 or 18 or something like that. And then you have merit, and then you have demerit goods. So they're looking directly at products. They're asking the question, what should a product be taxed? What rate should a product be taxed as? What this gives all of us a comfort is that we will see more convergence. We could see 12 and 18% convert converge into a standard rate, you could see overall the demerit rate come down. So I think that it's a process, and the process has started. The good part is that I think they will look at products directly, and we moved away from the equivalence principle, which to me is a huge paradigm shift in the way the council looks at products.
You mentioned 2 points. If I could just add politics also to the mix, because in the press briefing it did come up, and Mr. Jaitley's response was, well, if the consumer is benefiting and you'd like to see this as a populist move, then so be it. Mr. Bhutani, let me come to the other sort of important change that we have seen coming from the GST Council Meet is on compliance. They've eased the compliance burden considerably till 31st of March 2018, and until then, only the summary returns will have to be filed. The only filing that they have kept intact is the GSTR1, and that also for taxpayers of turnover over 1.5 crore, it has to be a monthly filing. But those below 1.5 crores, they've broken it down based on quarters, namely July to September, 31st December 2017 is the deadline, October to December quarter, 15th Feb is the deadline, and Jan to March, 30th April is the deadline. The GSTR2, Mr. Bhutani, which was supposed to be an detailed invoice level matching of the supply and the and what the sales and what the taxpayer has bought, that seems to have been given a little deferment of sorts, and there has been a committee that is been set up to look into when the timelines for that will be decided. What are we missing by not having GSTR2 filed on a monthly basis from now on?
Well, I think, Payaswini, there are 2-3 challenges that we have had insofar as a smooth implementation is concerned. I think one is the stability of the GSTN system and its efficacy, including availability of key forms. The second is the invoice matching exercise, and I don't know whether the invoice matching exercise is partly attributable to the stability of the GSTN system or the stability of the IT platform on which taxpayers operate. And I think the third challenge is which is very specific to small and medium enterprises, and I would categorize even taxpayers with turnover above 1.5 crores to be small and medium enterprises, and below 1.5 crore as micro enterprises. Now, all of these three have contributed in some shape and in some form to the degree of difficulty and challenges that taxpayers have been exposed to. And the government's response to that is in 3 forms. Number one, giving more time to be able to file the tax return. In fact, one of the suggestions I had made that for taxpayers less than 1.5 crore, why are you even insisting on the quarterly returns? It was monthly, they made it quarterly, make it once in 6 months, once in 1 year, at least until the time the system stabilizes. Because a substantial amount of taxpayers who fall in that category are still to be comply with it. And the burden of the penalty, which was working on a daily basis, I think 200, which has now been reduced to something like 50 or less than 50 as a result of the outcome of the 23rd GST Council meeting, is another area. So now there is a 3-pronged approach that the government has to be able to deal with all these challenges. One, give more time to taxpayers to file the tax returns. In fact, more time has been given to taxpayers with less than 1.5 crore. Reduce the penalty. The penalty regime has been changed, and to the extent penalty was charged for the prior defaults until the 15th of November, that would now be credited or made available as a credit against the actual GST liability. And the third, of course, is increasing the threshold for the composition scheme as well. Now, so you have to look all of these as a package that the government has come out with to be able to deal with the challenges that I spoke about. And I think it's indeed welcome, because this will help stabilize the system faster. Had government stuck to its original plan, I think it would have taken a lot of time to stabilize besides causing hardship to the taxpayers.
Anish, Mr. Bhutani touched upon the composition scheme and the increase in threshold. Quick word on the threshold has now been increased to 1.5 crore and eventually the plan is to amend the law and make it 2 crores. What does it mean in terms of businesses dealing with these composition scheme traders and manufacturers?
So while the concept of composition scheme is good, it makes life easier for the small taxpayer. Look at the psychology of large companies who are the ones who are customers to a lot of these small vendors. Unregistered vendors, you're already seeing that companies are hesitant and not willing to do business with unregistered vendors. It had to do
because they'll have to do the compliance for
them on their behalf. What we are also seeing is that companies are hesitant. They're not refusing, but they're hesitant to do business with composition players because they can't take credit for that. In any case, what happens with the composition vendor is that the inputs on which he is paid tax, they become a cost because he can't get credit for it. So the cost of supply for a composition vendor will go up as compared to somebody who's not on composition. So you will either see two things, that either you will see those who are not, because it's an option, either those who are not under the composition scheme but within that 1.5 or selling the same product, they could get preference. Or you could see consolidation and you go over that, which is not necessarily bad, but you're just likely to see that because the psychology of companies is to A, not do business with unregistered vendors, and B, maybe not to do business with composition vendors also.
Sure. Mr. Muralidharan, I'll give the last word to you. We've seen the rates come down from 28 to 18% for a variety of categories. The relief on the filing front and relief to composition scheme dealers, and add to that more time to file your Tran 1, which is the availment of transition credit. What do you see from the conversations that you've had with your clients as the next set of concerns that the GST Council should address?
I would believe, like for example, for services, we had a 6-monthly return. So irrespective of the turnover, I think if we make them file 6 monthly returns, at least the rush for filing of returns on a particular day, because even though we have the last date and there is a 1 month period during which people could file returns, you will find there is a lot of rush on the last 2 days. So therefore, the objective should be to prevent the rush in terms of loading the returns in the portal. So that way, I think a lot of returns could get postponed to a 6 monthly returns or a quarterly return. So that's the second aspect. The last one is, of course, there are a lot of pain points which the industry is facing. Just to give an example, for example, there are sectors which are outside of the GST, say the power sector, the oil and gas sector. So for these sectors, the input GST they pay are a cost, and straight away those costs have increased because service taxes were taxed at, services were taxed at 15%. Right. Now under GST they are 18%, so the cost has gone up, and these sectors are not able to offset. So therefore, one is the sector which are not under GST, so their issues need to be addressed, and also the sectors which are within the GST, like in terms of tax on advance, there are so many things, reverse charges. Right. So there are a couple of points which are there, which are pain points. So if they are addressed holistically, it would help.
Okay, well, here's hoping that the government will give a patient hearing to these asks as well. Mr. Bhutani, Mr. Muralidharan, Anish, thank you for joining us on the Fine Print today. Moving on, the matchmakers will now have to work doubly hard to present the best suitor to the bride. I'm talking about the marriage proposals in the insolvency world, where now resolution professionals will have to carry out additional due diligence before they take a resolution applicant to the Committee of Creditors. The bankruptcy regulator amended its regulations this week to ensure that creditors get adequate information to pick the most credible plan. The Fine Print asked experts about the intent and the impact of the changes. This week, the Insolvency and Bankruptcy Board of India amended its regulations, stating that though there is no restriction on who can submit a resolution plan, it should come from any person who can really rescue the insolvent business, and the Committee of Creditors is expected to approve the best of them. And to ensure the best reaches the Committee of Creditors, resolution professionals will need to present plans with relevant details on resolution applicants. these details should pertain to convictions, disqualifications, criminal proceedings, willful defaulter status, debarment imposed by SEBI, and transaction, if any, with the distressed company in the last 2 years.
The committee which is looking at the resolution plan can look at it very objectively without having any doubt on this whole issue, whether considering a proposal which is a higher value but from existing owners should be considered or disallowed simply because it is coming from existing owners. And it's quite relevant to keep in mind the fact that the RBI restructuring regimes clearly have all along allowed resolution restructuring with the existing owners, and till date that regime continues. In fact, for the second list of cases which are headed to NCLT by December deadline, in all these cases there is likelihood of resolutions happening where the existing owners are involved. So I think as a policy the law did not intend to leave out anyone. However, having a threshold of no criminal proceedings or no willful default is an objective criteria, and which anyone who is looking to run the business prospectively should be able to meet. And I think that clarification removes the unwanted doubt which was there in the discourse on the subject, and I think to that extent this clarification is timely.
To my mind, the experience which was gathered from the Synergies Dure resolution plan, whereby there have been accusations, I'm not sure how far they are true because the matter is still being kind of investigated, and the relevant financial creditor has gone to NCLAT challenging the NCLT order as well. But effectively it was alleged that the entire thing was done to benefit the existing corporate debtor and its promoters by transferring the loan to a kind of a friendly related party who was a financial creditor, and through that process they took advantage where the lenders took a huge haircut. So through this amendment what they are trying to do is that they are trying to kind of lay down minimum criterion, or at least lay down the minimum credibility level of the resolution applicants who are coming forward to put a resolution plan in relation to the insolvency resolution of any corporate debtor.
And it is perhaps to avoid a situation like this is why resolution plans will also need to disclose details on persons who are promoters or in management or control of the resolution applicant, persons who will be in control of the distressed company and their holding subsidiary associate companies and related parties, if any.
It somewhere gives a strong message that there should be something more which has to be done. Okay, be it the resolution professional who has to go through the transactions and who has to go like slightly more deeper, and also some onus on the committee of creditors while assessing the creditworthiness as well as the credibility of the resolution applicant, who might be the promoter, who might be anyone for that matter. So that the resolution plan, like what they accept, what they consider, is something which is which is viable, and there are no defaults immediately after the approvals, because there's a lot of effort which is going on, right? So nobody wants to kind of do anything in haste in a way. So I think the intent of the board and of the people who are involved, they just want that let's spend some more time, let's go a bit deeper into understanding who's coming, is it a proxy, a face being used or something. So let's do a proper assessment.
If you see the scope of the information which has been requested under the amendment of the regulations can be kind of fairly broad, especially in context of the connected persons, because let's say if a resolution applicant is a private equity fund, right, the kind of information they are asking for is the management of the or any person who exercises control over the resolution applicant, or any person who's holding a subsidiary or is also an associate or a related party of the resolution applicant. Effectively, that could mean that these funds may have to disclose right up to their ownership in terms of the limited partners investment, which they may not be very forthcoming and willing to disclose. And to that extent, up to what layers and the levels will with an IP go is something which we all will practically see when things progress. But certainly also one needs to keep in mind that the impact it may have in terms of on the timelines for the insolvency resolution process, because there is a hard timeline within which a resolution plan has to be submitted to NCLT for approval.
According to the bankruptcy regulator, all these details will enable the Committee of Creditors to assess the credibility of a resolution applicant. The Bankruptcy Board's media note also lays down the test of creditworthiness of a resolution applicant, but the amendment text doesn't spell it out in so many words.
In my understanding, I don't think that they would look at creditworthiness, but of course these criteria which have been specified, a resolution applicant will definitely have to meet those criteria. And as prescribed under the code, there is also a provision which requires that means available for implementation of the code. So those powers are already there. It's not that or those provisions are already there. So a resolution plan has to ensure that whoever is putting forward a resolution plan identifies either the sources of funds or a detailed plan in what are the steps one is thinking of in terms of implementing the plan and also for revival of the company.
The increased scrutiny requirement is not just limited to the resolution applicants, but extends to the distressed company as well. Resolution professionals will need to inform the Committee of Creditors about any preferential, undervalued, extortionate and fraudulent transactions done by the company in the last 2 to 3 years. So far, resolution professionals were expected to report such transactions to the NCLT if it comes to their notice. But experts point out that now they will need to actively investigate such transactions.
Let me start with a small reaction to this. The timelines continue to be 180 days, right? They are fixed. And the expectations, they keep going up. Now, somewhere, because of all this, the onus, again gets to a resolution professional that you don the hat of a kind of investigator. Because earlier what we read, what we interpreted was prima facie. If you come across something which is which raises the eyebrows and you want to kind of highlight, get explanation, and which either needs to be reported to COC or to NCLT, then you should. But now by kind of putting extra emphasis, by bringing an amendment, by changing a particular regulation, it kind of it kind of puts us in a slight dilemma while we think that running operations on one side, ensuring going concern on the other, trying to bring all the stakeholders together on a single platform where they can because it all starts with a trust deficit. So you need to really kind of put in a lot of effort there. Now, in addition, by putting these clarifications or because it says either found, determined or observed. Now, somewhere there is something beyond that prima facie phrase which is normally used. So you need to kind of be very conscious of all the transactions which you go through.
I think the regulations prescribed for reporting any extortionate, undervalued or transactions which are in the nature of fraudulent preference, and I think the RBI restructuring requirements also prescribe for concurrent audit and techno-economic viability to be done as a precondition for approving any restructuring or resolution. And if you look into this requirement in little bit of detail, you will see that if any alienation of property has happened without company getting value, or if there are onerous contracts which are entered into by company, those are things which would also come out in concurrent audit, and the lenders would not be comfortable in allowing restructuring subject to these arrangements not being discontinued. So I think in some form RBI also prescribed this requirement, but yes, this is now coming in the regulations and has force of law, so RPs will have to comply with it. But when they commission the concurrent audit and techno-economic viability study at the initiation of this process, I think they will have to just make sure that whoever is doing this assessment has to keep in mind the requirements, and on that basis it should be very much possible to make the determination, and to the extent that something doesn't come out in this study, there should be protection available even with the wording which has been introduced in the amendments.
The protection point is critical to give resolution professionals comfort that they won't be held liable if the existence of such transactions comes to light at a later date. That's all that we have for you on this week's show. Thank you for joining us here on the Fine Print. We'll see you next week.